he talks about being close to the money all the time, and like that's like the first time I've ever felt like close to the money in my life.
Yeah.
Like
when I was in construction, I used to commute, but like now I have zero friction doing what I need to take a step forward and getting the feedback to do that. The nice thing about zero DT is like you have the data and we get the reps quick.
Definitely makes me rethink of like the W2 life.
Okay, here we are, everyone. Connor is 24 hours into his options boot camp here in Texas.
Yep.
So, I rang him out because he was outperforming me significantly in the fund. So I figured success leaves clues, and I could probably learn something to him. So I brought him out. So you want to share how you've had so much success trading options thus far, Connor, of what you learned along the way?
Well, I honestly have to give credit to my sensei Mark on a lot of this stuff that he's taught me.
Wax on, wax off,
wax on, wax off. But honestly, it's just following the equations that we've been doing and following the game plan that we've been doing and just putting it in all the Excel spreadsheets and just learning from him and taking what I've learned from a lot of the other like trade busters and a lot of other videos and just applying it into my day to day.
So are you believers the edge real?
Edge is real.
Edge is real. The risk is real too, which I'm afraid you haven't quite experienced yet.
Yeah, I'm scared. You know? I'm scared that's going to happen.
This is the other part that I think a lot of people fail. So I guess what are your thoughts on the risk of options now that you believe they make money?
Honestly,
two sides of a sword. You only make money in the options because it has the risk. It's just you can manage the risk.
Yeah, like you have to take risks to make money, and there's a lot of when we're capturing a lot of that premium, of course, there's risk going to be arising with that. But I think that kind of if you fall back on the sort of the math on it and you fall back on a lot of the Excel spreadsheets, like the portfolio spreadsheet that we're tying in, I think that kind of helps us out a lot to kind of see, like, what are we willing to risk on that? What are we all right with losing on that? And as long as I think you have that mathematical thought process, like, yeah, there's going to be things out of your control, but I think that's going to keep you more afloat.
Yeah, and it's like the numbers can definitely be wrong over a period of time, but the rendition of the systematic game, which is like what we're trading, is the drawdowns are worth every penny because that really starts to teach you what you're willing to put up with and then where kind of the weak parts are in your portfolio. However, we could just rip it for like a year. Like, who knows
exactly
what quite that looks for, but it's always an interesting equation that even I think about, but I always find new ways to kind of ground it some way mathematically to carry forward. But I think you're a good example because you're the ultimate example of just behavioral edge.
Yeah.
You know what I'm saying? Like,
I get excited and I get scared and all of that. Yeah, I mean, it's really funny when you talked about that for the first time. It was just like the whole behavioral hedge thing. I'm like, yeah, especially now that I've really been looking and tracking a lot of my trades and tying into the trade logs and then going back and then looking at the market every single day. Yeah, I feel the highs and then I also feel the lows a lot too.
Yeah.
And it's been an experience.
So when do you think you're going to be ready to run the completely solo portfolio and I send you out of the nest?
I think we're getting there, man. I think we're getting there. It's definitely nerve-wracking, but I think these past couple months, honestly, I'm starting to understand the expectant value equation, and then we plug it into the whole portfolio and just finding a trade with edge and how it fits in there. I think when I start understanding where we go next and how we continue, like I understand at the 30,000 level that we're at right now, but like what does that look like at that 60,000 level and like what trades are next and when we increase it to the 60,000 level. So that, I guess that's my question to you, is just to ask, like, you know, when you're sizing, when you're putting more capital into your account, when you're going from making that jump, what trades do you need to actually change that? I know we talked about adding to, but like what are those two?
Yeah, I mean, like, you'll kind of see two types of people when they trade options. It's like there's the mechanical entry iron condor crowd, which is like, I have 30 grand. I'm going to sell $1.50 iron condors every hour, 6 times a day with a 1x stop loss. And it's like, I don't really like that trade as an initial trade because that trade is just really good at not losing money. Yeah. Which can be frustrating for people when you trade it and then the emotions of like staring at your screen to end up averaging like $25 a day just aren't really worth it. Yeah. So I like what we've been doing, where it's just like one trade, 20 minutes, we're out.
Yep.
Or one trade off the open, we know we're good.
Yeah.
But I think now, when you go to 60, it's like that mechanical entry iron condor could be a good thing on it, because it's like now we're propositioning our buying power on a daily basis.
Yeah.
Rather than waiting for some filter, and then we won't have as boomy or busty. So it's almost like the bond of the
Makes sense.
option trading portfolio. But with that one, you really just have to grit your teeth and sit through it. And it's like it'll go 90 days without making money.
Really?
Very routinely. But then you have a good month where it just kind of rips. And then the other thing is, it's like, how much risk do you want to take? Like this is the thing where it's like people see a back test and they think about the money, but you obviously have to continue to maintain it. So it's like, how much risk do you want to take? I mean, I know it's a little in between, because it's like neither of us really care how much risk you take, because it's not a marginal amount of the capital we like have.
Yeah.
So like if it goes down by 20%, like emotionally we have nothing going on with it. But
I like to see it as our money though, and like treat it as I would treat it in real life.
But you can build a business that is trying to break things. It can go really quick, or you can build a business that is like a senior living center. You know what I'm saying?
Exactly.
So I guess the question would be, what type of business or return do you want to outlay with the options account? Because my thing is like, I'll lead you down whatever route, but you should make the decision of what that route is. And like,
and to be honest with you, I would say for me personally in my life is where we're getting, where we're hitting like that 40%, 50% yearly returns. But, and obviously we got to take risks to be able to hit that.
Yeah.
But like also that we're not taking too much risk. So if it does stop out, like we're just taking massive draws, you know?
Yeah. And like kind of another way I would describe it is, it's like risk, you know, if it's got time, also as a function of time. Yeah. So like we can take a lot of risk. Like let's say we up the portfolio to double the size, and we're going to trade what a 40% drawdown would be. Not saying we do that, but if the second you start making money every month, you take off 100% of the profits and put it in bonds, you could actually potentially run at some very, very large size.
Yeah.
Because you just started out on it. And this is kind of what we did with a 30 grand portfolio.
Yeah.
So we were just so small at the time, but now we start to have the luxury of, do we want to do more of what we're already doing? We're not going to do that because it wouldn't make very good content.
Yeah, of course.
But we could take a more conservative play like mechanical entry iron condor, or we could add more risk to return trades with larger stops, but we could outlay the capital into just a bond ETF as we make money. So like, and that's not necessarily more risky. It's like the real only risk we have is like the drawdown tax. So with how our thing is going, like we don't want to size much bigger than like a 15% max drawdown. Yeah. Because then it could start hurting.
Especially on an account like 30,000, because you don't have a lot of capital.
Yeah.
You start hitting draws.
But like a 10% drawdown, we're only 11% to get back to even. And for that account size, like we might as well rip it.
Makes sense.
So what type of business do you want to run with the portfolio at 60 grand?
At 60 grand, I might as well make it fun for.
You might as well run it hot.
Might as well run it hot. You know, I mean, it's fun to watch, and I think that's what I'm going to learn the most at is like when you're running some risk, because you play it safe all the time, especially when it's like this size of an account, and the purpose of this content is like I think I'll learn so much more. I'll learn like what really is risk, and start learning like how to manage my risk, and start learning to manage that behavioral side of it as well. So
and the other thing with behavioral hedge is everyone's like, oh, systematic, you never have to worry about it. And it's like, that's true if you work a lucrative job. Yeah. And it's such a small portion of your account, but like even if you're systematic, there's still a large emotional component to doing 100%. It. And even if you never deviate from your mechanics, it could still be very painful to execute that when you're at the lower end of it. And it's like, I was telling you this earlier, but I had watched this guy present to Discord I'm in. I don't know what his actual name is, but he goes by Special K on the Discord. And he was talking about like p values, which is how statistically certain are you that
Yeah.
this is not random. So like a p value of 0.01 would be like, I'm 99% certain this is not
Yeah.
random, and I have a 1% potential that this is random. So like anything on back tested for like 5 years, it's all going to be 0 basically.
Yeah.
Meaning it's not random. However, like you can hit a 3-month stretch and you could run that same p value only on a 3-month stretch, and it could be like 0.10. So you have a 10% chance it's random. So
Yeah.
like the way to think of it is like you have a 10% chance you're just flipping an even weighted coin.
Yep.
But you don't really know. And the 0DT market's still relatively new, but that is like ways you can backstop kind of whatever you're doing when you're trading that. But
do you feel like that kind of grounds you a little bit, like when you're like worrying about like your behavioral side of it, like you look at those p-value, get into the math, and that like kind of brings you back to like,
Yeah.
all right, it's mathematically based, like it's not too risky, like we are doing.
I mean, for me, I've committed to trading options so much
Yeah.
that like the risk I've taken in life to trade options is nothing compared to the risk I've taken trading the actual options.
Makes sense, yeah.
So it's like I'm going down with the Titanic.
You've already gone all the way in.
Yeah,
so.
like the 0DT Titanic I'm going down with irregardless. I mean, I've done, like, I'd like to say I engineered the Titanic ship, so that may not be the best enactment of what exactly that is, and I have built in like a margin of safety. Like if stuff went twice as bad as the data suggests, it would be okay, but every day you do it, it gets better. And like one thing I think of is like the ultimate trader guy is basically Jim Simons, who created the Renaissance Technologies, which was like the first quant or math fund. And they've done 66% compounded for like the last 70 years.
Yeah.
Like way better than NVIDIA or Bitcoin or anything out there. Like $100 invested at the start's worth like 14 million now or something. And like in his book, he's just like, if you're not going to base, like, what are you going to base a trade on if you're not basing it on all the prior data you potentially have?
Yeah.
So it's basically like the best guess we have. I know that doesn't sound calming to people, but that's basically a route. However, going back to the math thing, I know you've been studying up. So it's like, do you have any theories that you've kind of been jogging, or that you could, explain to the people here, like how to think of risk, how to think of sizing?
Yeah.
What trade do we want to add, or what is that? You
Exactly.
could pick one of those, but
yeah, like there's been a bunch of I've been studying, like, what is a proxy to risk, and we can just pick one of them. But really, I'm going to kind of take it a step back to something it's kind of like the overall arching theme of my question is to kind of get in your mind behind choosing your trades.
Yeah.
And I think it kind of ties into what the theories that I've been learning a little bit. Like, which of the theories how do you take the expectancy hacking theory and you plug it into your trades? Like, I just want to hear because I've heard it from the Trade Busters podcast, but I also just want to hear it from your mind as well.
So like, I guess there's several forms of expectancy hacking. So like the first thing is like options is the ultimate edge.
Yeah.
So like we can outlay collateral, like 20% of the money we need, or we can trade a, $500,000 instrument like SPX for $5,000 with a wing. So we're essentially able to write our own book without any antiquated rules of what we think risk is. Like the exact opposite would be is like if you wanted a loan from Fannie and Freddie to get a home loan, it's like you have to make this much money and you can't have this much debt. There's no like change in potential. Like personally for me, it's like I can't even basically qualify to rent an apartment right now unless they're willing to take all the cash from me up front, which makes me look like a drug dealer. But the instrument provides a lot of that with the margining of it.
Yeah.
And then that also plays to the risk premium, whereas like you're taking risk, you can lose more than you outlaid.
100%.
So like both of those factors, it's like you can get cheap leverage and you can take risk that often doesn't blow up for a long period of time.
Yeah.
So like that is the ultimate benefit of it. And then as you get to larger portfolios, which is like not as applicable with you, it's like I can trade a hedge, and then that frees up my buying power and like makes me spend less money on wings.
Yeah.
And by having a hedge that when something blows up, like today's a great example. So I started the day overnight with a long straddle
Yep.
and then 2 short puts.
Yeah.
And those short puts got screwed. We're down 2% or a little over 2% today. But the stop worked because
Yep.
it was once the market opened. And then you just kept making money after the stop. So you're able to take your risk off. So it's like relative value. It's like you are able to buy an option that's fairly priced and then sell an option that's overpriced with a short option, but then you can lift the risk off when that inflection curve comes over. So I guess like that's the ultimate thing of expectancy hacking.
Yeah.
And then if we also like really dumb down the portfolio thing, if you have 4 trades that are all okay, if they're actually not related to each other, then the sum of them all becomes better. So like a lot of people ask me this about the hedge, and it's like the same concept applies to being capital efficient and using 4 or 5 other trades or whatever that may be.
Yeah.
And it's also like not as complex that you don't need to know all this information about it, because just by doing the act you're able to do it. And then the other flip end is like watching the tape, or at least how you lose,
Yeah.
is important because it gives you an understanding of where your portfolio is weak. You have to think critically, which is hard when you're initially learning through it. But I guess I would put that to like our portfolio is like what you're running right now. I know we haven't lost much, but there was a time in late December when we took like a 10% drawdown,
Yeah.
10-15% drawdown. So it's like, if you remember back, I can give you a hint. I obviously remember, but like, do you remember like what exposed us during those times?
Was it this is you're not referring to when we size too much like in
I mean,
February?
we're always sized large
Yeah.
because it's better to show the learning along the way. But like, we trade that all in an open trade. And when we trade that, it only trades on days when the VIX goes up.
Yeah.
So
the VIX was up a lot.
we have no ability to dig us out of a hole when the VIX isn't up.
Makes
And
sense.
and if we lose 3 times in a row, that takes 6 to get back to even. But if we only average 2 or 3 trades a week,
Yep.
you lose 2 in a row and your month's already done.
So you're saying we didn't have enough occurrences during that time?
Yeah.
Yeah. That
Hence,
makes sense.
The MEIC, this could help.
Yeah, and that's why that makes perfect sense too, because when we were looking at it during December, I think that's when we were struggling the most. When it was like we had like 3 or 4 trades in there, and then
Yeah.
we started throwing some more trades in
And
there.
also, this was when the fun was beating Connor's account, so it did
Exactly.
It did happen,
Yeah.
It did happen.
It did, yeah. And then we started adding a lot more trades in there, increased our occurrences, and you think that kind of just like leveled it all out a little bit?
Yeah, but I mean, the next iteration is, I'm talking you through it now, is like you have to recognize that and then diagnose it. So we have like a hypothesis of what's going on and what the problem is, and it's like, I don't know if you stumbled upon it, but in the last time you're like, we're going to go this long iron condor off the open.
Yep.
So that doubles our occurrence. But going back to the initial expectancy hacking thing is like you said in the beginning, is expectancy hacking is the margin. Options are a free lunch that we can take more risk
Yep.
to get more risk premium. Not saying you can protect against it. There's 2 parts to it.
Yeah.
But we weren't using that half of the days.
Makes sense.
And if you have money that's not working for you, it's dying.
Makes sense.
So that's a point that I think proxy of your risk, or whatever your original question was. It's like we have to think about that, and humans are good at recognizing patterns. Or a lot of people ask me, it's like, what's up with discretion? Why don't you use any discretion?
Yeah.
It's like you can identify a pattern in the market or your weakness with your portfolio.
Yeah.
And then you can program in a back-tested trade that would eliminate that pattern that you've seen. So you can exercise your opinion of whatever that pattern is. So where do we struggle right now in your portfolio if you think critically?
So last time,
or what risk are you unaware of? You don't necessarily have to have an answer to this, so you don't have to if you don't.
No, yeah, we kind of talked about it last video a lot. You said we're kind of looking to more go in the afternoon.
And why do you think that is after this preface that we just had?
Do we just not have enough occurrences in the afternoon, basically?
Yeah, and if we have a trade in the afternoon, do you think that's going to be very related to the trade that only happens when the VIX is up, or a calendar, or whatever it is?
Yeah, it might even it out a little bit. Yeah, it's going to help us if we lose really bad at the beginning and we have more occurrences at the end, maybe we can rally back at the end of the day a little bit better. And so we don't have to rely on the beginning of the day so much. Is that kind of the thought process behind it?
Yeah.
Yeah.
But it can cluster.
That's true. Yeah, that makes sense
too.
So,
like, the other thing is, all-ended open has a big stop loss.
Yeah.
And calendars can screw you, too, on a big stop loss. So, late in the day, if we run that, probably wouldn't be a good idea to have a big stop loss on it.
So, no filter trade in late in the day that has a lot of occurrences. Is that kind of what you're thinking?
Yeah, with a small stop loss.
With a small stop loss?
Yeah, but in regards to that, if we have a small stop loss, we can trade it big.
Yeah.
So we can take significantly more size with that trade. And I mean, that's a loose example of what we're doing through, and we'll go through the episodes, but I'll answer like any more questions you have, or we can have like a conversation around concepts that maybe is just good for you to understand. Because like the portfolio thing is going to be easier as we go through it. And then we'll have a back test we can like share with people and be like, this makes sense. And then if we screw up, everyone will be able to see
kind of dive in just a little bit deeper on expectancy hacking. Like, I know there's a lot of different triggers that you pull from it. Like, you can pull the risk to reward trigger on it. What other triggers are you like pulling on it? Because that's what I was like seeing from my study is like, and we've talked about this previous videos, like when we did the whole expected value.
Yeah. So I guess I would say it's like, now I only play in portfolio land, which is much like harder for people to think about.
Yeah.
Which I don't know if it would benefit people. So like, is there anything specifically, what other trigger, like, or if we're looking at a trade?
Yeah, like I'm just looking at a particular trade. Let's just say we're looking at a trade and we're playing with we've already played with the risk to reward and we're like, all right, we like where it's at. Or is there anything else on like the sizing that you can increase it even better?
Yeah.
Or do you just stick with the risk to reward and just let it be at that,
I mean, there's a bunch of different ways you can play it. So it's like you can use a filter.
Yeah.
You can use a different time of day.
That's what I was going to ask.
You could pick a direction, like puts or calls, or you could trade them both. And then you could also go like at the money. So I think one that a lot of people veer away from because it's harder to understand is like if you sell like a straddle at the money, both 50 delta on each side, just get as much premium as you can. The premium capture is going to suck on it. And people are like, ooh, I don't know if this works. Mm-hmm. But by having that, when the market doesn't move at all, you'll make like 3% on your entire account with like one contract.
Yeah.
Which takes nothing. So that in itself can almost be like a really uncorrelated return stream that uses like no buying power.
Makes sense.
It's kind of similar to the power hour thing we do when we do 40 delta on each side. It's 10 wide. Yeah. We're just holding it. But then the other thing that a lot of people don't look at in zero DT, which I think it's very foreign, it's kind of a new thing, is like diversification through execution. So you can have a trail stop, you can trigger off volatility, you can use a stop loss to like protect against your risk, or you can not use a stop loss and use a tight wing. So like quick down and ups don't hurt you.
Yeah.
And by combining all of those, you're not as exposed to the same thing. Granted, there's days that suck.
Yeah.
And those days you just lose.
And it's going to happen.
Yeah, and sometimes they happen back to back.
Yeah.
Like it just is what it is.
So it's this kind of practice through execution. Like you're seeing what's working and what's not. Like you're following the math, but then you can start seeing what to add on to it or like what to change to the trade by how it's executing in the live market, basically.
Yeah, and this, like the analogy that I really like, it's like anyone that's been to a gym sees like the cigarette smoking construction worker that comes in at like 6 p.m.
Yeah.
And he's like in really good shape.
Yeah.
But he just goes there every day, smokes a cigarette and squats his weight, and then goes home and like drinks a beer. But he just does the work and he works hard.
Yeah, makes sense.
So like you don't need to necessarily understand like all the science or what's going on with it. Whereas like conceptually, if you do it and you kind of throw it in there, you're going to do okay. And we already have limits with everything being precise because we don't have a big like $1 million account.
Yeah.
And when we are just conceptually understanding and throwing that in, it's like it's a relatively good investment thesis for zero DT. Like take it with a grain of salt because we're doing the best we can. And also options are based on a population distribution.
Yeah.
And the best way to describe a population distribution is like if the average male is 6 foot, that doesn't mean if you go to Minnesota where there's shorter people, maybe there's tall people in Minnesota, but like the average person in Minnesota will be that tall.
Yeah.
Because you're just randomly selecting from the whole population, and it can be skewed at other parts. So that with options is relatively random, where your uncorrelated traits could all cluster.
Yeah.
And then your correlated traits could not cluster, and you could get the best. But eventually those will hit you. And that's why in a big portfolio, I buy an option, I sell an option at the same time.
Yeah.
Because that's the only thing to guarantee to cancel it out.
Yep.
And like you'll use a profit take on one, and then you just won't even use a stop at all on the other.
Makes sense.
And like if we want to sound smart, it's like there's mean reversion in the market. So
Yeah.
like when the market goes down, it's normally due to come back because people overreact to something.
Yep.
So like using a profit take on a long option is a good idea because you take your profit once you've eaten a bunch of risk before it bounces back. But like shit can always get worse in options and in life. So it also makes sense to have an option that you never buy back. And you just, even when you're like, I've already made 10%, there's no way this thing could keep going.
Yeah.
You just let it keep going.
All right.
Because 2008 and 2020 show that. But I guess what I'm coming to with this randomness thing is it's like, it's about asking the questions and conceptually understanding what that is, and then being curious for what the result is. Because most people aren't going to run a portfolio like me or spend that much time learning about it. But if you understand the concept and are asking yourself the questions, it's like it's going to help you take risk in life and in your options portfolio. But size is the thing that's ultimately going to kill you.
Yeah.
Because you can't stick through it.
You can't go too much size. And
Yeah. It all comes down to setting expectations. So it's like you have to set the expectation of like what you want to outlay in it. And this is kind of even the mental side or whatever, you know?
Yeah.
Where it's like you can be a terrible manager, but if your subordinates love you, it doesn't matter because everything you say, they take it with a grain of salt. Like you mean well, you know?
Yeah.
And vice versa. And it's like, that is the mental component of kind of trading. But when we talk about the mental component, it's like mentally, what can you backstop to that? That's objective. So your ego won't get in the way.
Makes sense. I do have a curious question though. Just thinking about everything that you were just saying, looking at our portfolio, we talked about adding 2 trades to it when we get to 60,000. Like we talked about adding the end of the day trade. And do we start playing? And this is a kind of like just a curious question. Do you ever really play in the middle of the day at all? Like 1 p.m. to close?
I mean, I do, but if you have a small portfolio, it's the worst time of day.
All right.
And you already can't really pick it.
Yeah.
But like I've looked at data on it, so it's like basically everything between, let's call it like 11 and 1.
Yeah.
Is like half as effective as the rest of the times of the day. However, by trading it, if you were to take every 15 minutes, instead of trading twice as big at the end of the day and the beginning of the day, you would spend less time in drawdown, and you would also have a better risk to reward for drawdowns, because on the worst days when it reverses, even though your end of day and beginning of day trades make the most money, that middle of the day trade that averages like $1 for every $100 you sell is able to offset that loss.
Makes sense.
But with a small portfolio, it's like you already don't have the means to do that, so you might as well pick the best times.
Makes sense.
Although,
yeah, all right.
Like what I would say with what we're doing in the future is we should tranche it. Just
that's what I was gonna ask.
It's a lot of repetition for you, and you'll learn.
Yeah.
And then like, you know, we'll kind of leave that one open for iteration. Because the other thing too is like if you size all in and open too large, like you're screwed.
Yeah.
Like let's say you put in a 2 lot and you're supposed to be at a 1 lot. And then finally when it hurts and you're at a 20% drawdown, it's like and then you size down to 1 lot. It's like, so you need 10 winners to get back to even. Now you're half the size. So you need 20
winners. You don't
winners.
want to just throw a tranche in there that might not.
Yeah. And basically you're going to take 4 months to dig yourself out of that all in an open hole. But if you tranche and you start out with a $3 option on each side, and then a month later you're like, let's change it to $2.50. Like you're making so many occurrences and it's so similar. You just went from $2 to $3 or whatever it is. That data wise isn't really like, you can tinker with it a little bit.
Yeah. All right.
So it's like, I think that's just a good learning trade despite my gripes with it.
Yeah.
And it's also good exercise in like, oh, my slippage is off and this made a huge difference.
Yeah.
And I think a lot of people struggle that.
You can kind of notice like where your profit is getting
Yeah.
cut out when your slippage and stuff.
And then we'll curve fit it a little bit too that we can play with like
Yeah.
times, and we'll see like, is it worth it for.
Yeah, I haven't found a good tranche. I've tried to back test like performing in 2025. You know, I kind of listen to Tim Wise's stuff and then I go run the back test, and I haven't listened to what he's doing in 2025 yet. But
Dude, he's always changing. For reference, Tim's a guy on another community, and he's always looking at patterns, and it's like he's very spot on that there are patterns in the market. Like generally, Mondays volatility opens up high, selling in the mornings on Mondays is good. Like Monday closes are very volatile, Friday closes are very unvolatile.
Yeah.
So like all those patterns exist, but it's just kind of the flip side of the opposite where there's no randomness, and if the data's off at all, like the whole model breaks down into randomness.
Yeah.
So you're kind of using rules to play and trade. But I mean, we trade the Monday curve fit, which has done phenomenal.
Yeah.
For a long period of time. So there's a place for all of that in everyone's portfolio if we can just beat up the test a little bit and can, assign why we think it makes money.
Yeah, I'm excited to dive into that one because, like, honestly, it makes me a little nervous just because there's so many filters on those tranches too, and it's just. But yeah, I'm excited to dive into that one as well. Would you? My next question was to be like, you were mentioning clustering a lot, so like to not cluster, would you put that one at like one?
You have no control over it.
Really? There's no control over cluster. So explain that to me.
So if something is 0.2 correlated, like 20% zigzag, that's still going to be correlated 20% of the time. But what people often don't understand is like that's like all the worst days, because when stuff blows up and there's a new risk premium out there, like everyone's screwed basically.
All right.
Because it's getting repriced in. So even though it's 0.2 correlated, like you always take your drawdown on your worst day, right?
Yeah.
So those are all correlated at the same time.
Makes sense.
Which is the problem with trading them, and they're all credit trades, so they're there. So like long vol and short vol is inversely correlated. And I think a lot of people get this wrong where they're like, we want uncorrelated investments. It's like, well, there's only correlated and inversely correlated. There's not uncorrelated, Yeah,
you can't be, everybody would love to be at zero, but
that's not really true.
Yeah.
But the inversely correlated is the long vol and short vol. And then the other flip side that you can kind of do this with is like if you're trading a like at the money fly, you're just short ball, you could trade trend alongside it, and as long as it doesn't reverse, that would kind of help. So like that's what my portfolio did today. We made money and the market was down 2%, even though I got blown out on everything. I traded in the morning, but this is kind of where the margin of safety comes in, where just because in the past you've only had a 10% drawdown means nothing that it can't cluster for 2 days in a row.
And just freaking
like we haven't had Donald Trump tweeting for the last SPX dailies, And I think a lot of people just learned what this was, but this is kind of the beautiful thing about the options market is it's like imagine you get so like Donald Trump comes in, starts tweeting, wrecks everyone's 0DT trading.
Yep.
Then Donald Trump saying weird shit and pushing back tariffs 9 times.
Yeah.
Like has now repriced the vol, and we had a good month.
Yeah.
Or a good 2 months. And it's almost like imagine you were in a sales role and you were making a bunch of money, and then you got sent to a new territory that sucked.
Yeah.
And you couldn't make any money, but then they just repriced your commission. It's like that's kind of the beauty of options. It's a much truer form of capitalism, and there's always a trade-off. Like people always talk to me, it's like, why do you use 40% of your buying power trading 0DT or whatever? And it's like, if you blew up, you'd need like an 80% gain to get back to even or whatever.
Yeah.
But at the same time, it's like, what if the government changes regulations and it's no longer there?
True.
Or so many people pile in that like, this just kind of changes a little bit. So time is a function of risk. I don't think a lot of people think about also, and a lot of people's investing strategies, which was put a bunch of my money once on NVIDIA 2 years ago, and then they made out and they're basically good. So that's always a function of investing when we're doing it and thinking about risk is how long do you have to hold the bag. It's like not using a stop loss doesn't sound that scary in the last hour of the day. It sounds pretty scary for the whole day or overnight.
100%.
You know?
So what is your mindset behind that risk? Like, you know, is it just minimize? You know that the risk, you can't control if the risk happens, right? You know, like you can't control that market. Are you just on the front end? This kind of goes into the credit as a proxy for risk conversation.
Yeah.
Like, do you mentally just say, I'm just gonna put in my equation that it's just gonna be a 2x loss, or like,
yeah, I mean, that's not your risk. Like, the thing is like your risk is always going to be your buying power.
Yeah.
Like, there's no way around that. But risks that are like very unlikely, the way I've theorized this is the options market in my mind, or the stock market, has failed like 3 times in modern history.
Yeah.
It was in 1987 when they priced puts and calls the same and the market went down 20% in a day, which would have been catastrophic. Then in 2001, they had like a lot of the exchange technology in the World Trade Center. Hit the World Trade Center, the market was closed for 4 days.
Yep.
It like opened up at some random price 4 days later, and they had to basically make up rules, like literally out of thin air, like how to price things.
Yeah.
That obviously wasn't around with 0DT and whatever. And then in 2010, like they didn't really hold bids back in the market, and the flash crash happened, and it like went down 7% and went up 6% in like 40 minutes.
Yeah.
And they fixed all of these, but this just shows a cadence that every 10 to 20 years something will break. And also anything with a single point of failure will eventually break. So I do anticipate 0DT breaking sometime. I don't necessarily think it's the full loss of the buying power, but like trading 0DT for 3 or 4 years, it's like I've had 3 to 4 times the premium I've sold at what my stop loss was supposed to be in slippage.
Yeah.
Happens very seldomly, but
so your risk is way more overarching than just looking at a singular trade. Like,
yeah,
this is going to break.
Like, I think if you're using 40% of your buying power, like 20% is going to happen in the next decade.
Yeah.
Like, you're losing half of that. And like, no matter what you choose, you're always exposed to some type of risk, because again, there's a trade-off with it. Whereas the ultimate risk is just, if you hold money in cash, you're good. And like protecting against risk when you already have enough money and you have your house paid off is like much different. But the benefit of using a stop loss is, okay, they do work, and you are using the most liquid instrument on earth. Options do get funkily priced, but the trade-off is, what are you going to do, hold an option overnight?
Yeah.
It's like that gap's a lot more than 0DT does.
Yeah.
But the flip side of that is, like, since you're not holding as much risk, you have to hold like 10 times more the risk for half the time, which is what you do with 0DT.
Yeah.
So there's always a trade-off. I feel comfortable with it. I've done it for a long time, but there are problems with all of those assumptions. But generally, like, not worrying about something that's going to happen 10, 20, whatever years down the road. And like, I do buy hedges. I am always long contract of what that is.
Yeah.
So if we go down 20% instantaneously, I'm going to make money. If we go down 7% instantaneously, I'll break even. But if we go down 3% instantaneously and then it rips back up, like, I'm losing a lot.
Yeah.
So being able to quantify that risk and like what that is, I think makes a lot of sense. Or even another thing that I do is, like, I use widespread. So I'm buying like 5-cent wings.
Yeah.
And I never want to take what the market's quoting. So if you have 100 widespread and the market popped and you're only buying back your short, you could technically buy it for $150.
100%. Yeah.
So I like cap what it is, and it's like, how do you theorize what the best max price is? So you could say $100 because that's the most you can lose.
Yeah.
Which is valid. But you could also say like 50, because you're basically saying you have no. So like, if the price gets irrational on the quote, like the stop loss, even though you have a 2x expands at 100,
yeah,
you're saying I'm not willing to pay more than 50, even though my max loss is 100x.
Yeah.
And then you give it some time to potentially bounce back because something that caused that. And I think that's like one of my views that I kind of have on risk a little bit. And it's like, something I would never do would be like buy 2 longs for every short I sell, because at that point, like, you're just spending so much money on protection that's still yet to have proven if it's paid off.
Yeah.
You're hoping for the worst to happen, which is a pretty bad bet and kind of cynical. But yeah, like,
That's interesting though. Like you pointed out, so like you always lead with your expectations with creating trades. Though, like you set your expectations for what you're trying to have a desired outcome with that trade, and then is that like your mindset behind each trade that you add to our portfolio? Like I know with your hedge, like it's a little bit different, but I'm just talking about my portfolio in sense. Like you always have a thought process behind what you're trying to achieve with the trade before you just throw it in there, right?
Yeah, you don't want to do more of what you're already doing because there's a diminishing return
100%.
to that. But like you
And
can
there's no
just,
diversification in that really. If you just keep doing the same thing.
I mean, everything comes in and out of favor. Like there's always a trade-off. So you could be trading something that's like we're trading something that's very in favor right now.
Yeah.
And when that falls out of favor, it's going to hurt a lot. But it can stay in favor for a year, 2 years, whatever that may be. And we'll show you guys some of the trades. We run some trades that we haven't been through on the channel yet, but they've been very profitable. Anyone who's trading all audit open knows it's been meh.
Yeah.
You know, I think the put side's been losing money and call is a little break even. But with that, like you have to have an intent for what you're doing. You have to have a concept that you're going after, and then you have to be able to stick to it for a long enough period of time, and you need to know where that weakness is. But in general, I'd rather hold a lot of risk for a short period of time.
Yeah.
That's like all of what I want 0DT, and then I want to make sure there's a price quote on it. So like the majority of my money is made by losing less when stuff's going down.
Yeah. Do you want to hold the most amount of risk for a short period of time because that's what has a higher PCR and you're collecting the most premium at that time?
That's actually kind of a good question. So it's like if I want to hold the most amount of risk, some people will think that's using all of my buying power and selling like a 10 delta option.
Yeah.
Whereas like if you're exhibiting the thought that I want to hold the most amount of risk for the least amount of time, it's like you want to sell that the money fly.
Yeah.
Because you're collecting so much premium that you're getting compensated for that risk. Whereas if you sold like 10 times your account size in a 10 delta put to get the same credit as one time your account size selling that the money options, like clearly we can see which one's going to blow up. Granted, you're going to win a lot more frequently with the one further out. So I guess it would be like you need to tie the risk you're trying to capture to the expectation.
Makes sense.
In which you're trying to
achieve at the same time.
Yeah. Like you don't, like if you think, AI is the next big revolution.
Yeah.
It's like you wouldn't buy NVIDIA, you would buy like a 3x levered NASDAQ.
Makes sense.
Or whatever that is, because if AI hits, the NASDAQ's going to buy it.
Yeah.
Whereas like if you're choosing NVIDIA to hit, not that it's a bad bet, it's like you're only choosing one company to do that.
Diversifying yourself into a whole thing. Yeah.
Yeah.
That makes sense. But I was gonna kind of just dive a little bit deeper into that as well. When you're just looking at like what is your like some of your convictions by like what trades do you have like high conviction into? That's one thing like I was pretty interested in, like when everyone kept saying like during my study this week, they have like if you have high conviction, you have high conviction in certain things, you act in a certain way, you're gonna like leverage it really hard. Like what trades make you have pretty high conviction on?
I mean, I have conviction in different trades for different reasons. So like I have a trade that I trade overnight or that I do long ball.
Yeah.
And it's like I am very confident that like abnormal events occur much more often than they're priced.
Yeah.
However, and I can't blow up from buying long ball.
Yeah.
However, that shit pins all the time and I can never predict when it happens. So like I lose a bunch of money constantly on long ball. I've lost more than a house this month.
Yeah.
Like 380 grand on long ball.
Yeah.
But it's already starting to turn over. I would think I was up to minus 500 grand on long ball like a week ago. And that trade is great, but you need to have it behave and be sized in the right manner. Whereas like trading some type of condor or whatever, it's like, you're taking a lot of risk for something that, like, let's go. I keep on picking on MEIC, but it's like you need to trade a lot of size to make money. and you're managing your risk with a stop loss, which could eventually not really work.
Yeah.
So like that's why like all in it open, even though you take big losses, like today you would have broken even on MEIC,
Yeah.
obviously lost on all in it open, but like I could never really blow up my account if we had like a 3% gap with all in it open.
Yeah.
So you need to kind of consider all of those trades and what you like on it. But personally, the thing I have the most confident in is like long vol works because the frequency of bad stuff is more likely. And when I say long vol, like this also includes just buying calls because the market goes up over time.
Yeah.
And then the other thing is like I'm a firm believer in trend. Like saying it's just an EMA is a very, like the moving average of the price is very simplified. But people get greedy and people get fearful, and that like trend continues, and the way market dynamics work, like when it goes down, it's going to keep going down for a little bit until it decides to go back up, and then it's going to keep going up. And when you think it can't go down anymore, it'll go down more. And when you think it can't go up anymore, it'll go up anymore. And that'll fall, but that falls also in and out of favor.
Yeah.
So like you have to earn your stripes with all of these.
Yeah.
And then when they're combined, now you're like baking and understanding what that is. And, you know, anyone, like the best chef could make an amazing cake. And when they make that cake, you could give them, like I could give you the recipe and you could make it and you could fuck it up.
100%.
But it's like when you see how someone makes it and the order you add the ingredients and all that stuff, that's really where it comes in. So it's like you've basically learned how to shop, and then you can turn on the oven.
Yep.
But all that stuff in between there, it's like you can follow a recipe, but you can't, you know, actually do the whole process of it.
You haven't followed the process a million times.
Yeah.
Like
and,
that chef that.
And another thing too is like systematic, everyone likes it, whatever. But being able to systematically run a portfolio is you have to actually run it for 6, 9, 12 months and like see trades die and stick to the trade for whatever, and like cross the elephant graveyard and Lion King of like a trade that sucked and came back.
Yep.
And that's kind of like the hero's journey of a trade. It's like you had a call to action to do something, you did it, then you go out, and it's like the villain or the market regime knows who they are. They're just like, we're reversing this shit, we're going straight up, everything's going to the ground, it's going down, and you're like the hero in the elephant graveyard. If you haven't seen Lion King, this is what I'm referencing, where you're the most lost person of all.
Yep.
And your guide is the numbers on how you're going to, you know, relate to what that is. Like I was running this p-value thing like I was talking about the other day, and I run a 7-day straddle that has an even expected return. Basically it expects it to get no value, and the p-value is 98 on it, which basically says you're 98% certain this is random. So it's a weighted coin flip, which makes perfect sense because it's got a $0 expected value.
100%.
Then I have another one that's like got a 8% premium capture, and it's got a 20% potential that it's, you know, not random, that it's 20% that it's random basically. And with both of those being long ball, it's like, okay, that makes sense. Like I am willing to accept this is the nature of it, and it gets really bad. And then when something goes bad, it like rips back.
Makes sense.
And all these are all the behavioral bias and the trends that comes through. But you have to be able to protect against the risks so this goes long enough, and then you only get the benefit of combining these in a portfolio when it hits you less on the worst end of the spectrum, then it helps you out significantly more on the other end of the spectrum. And you're not necessarily going to like figure that out, but 08 and 2020 happen once a decade, and like those are way worse than 2022 or what happened on August 5th because they were prolonged. And it's like you're gonna redefine your data set when that thing happens.
Yeah.
And like I like to say, it's just gonna be twice as worse. So that's kind of what I built into my, like, I have the same bias as everyone else, except I'm just exercising that in a different way.
Yeah.
And my bias is I don't know, and I think it's going to be twice as worse than what statistically I can quantify before that.
Has your behavioral bias like almost numbed out after for such a long time?
Not
like,
at all.
Really?
Like, I still feel it, but I have all the backstops to not react to it.
Makes sense.
So when the market's going bad, I'm like neurotically checking stuff to like use numbers and whatever. I'm not changing stuff.
Yeah.
The only thing I'll change, and it's so minor at this point because I'm size small enough. It's like if you're size too big, time to start like resize is now.
Yeah.
Like that's really the only thing. But I'm not dropping anything.
Yeah.
Like I have 2 trades that I've been trading for a year and a half, and I'm still lost money on them.
Yep.
But it's completely fine because the sum of the parts are the whole thing. And
can I ask one question?
Like, so what keeps you confident in those trades is just constantly checking the the trade logs and your back test. Like, is it just conviction in the back test? Like, hey, that's matching right now, you know, and I know it's gonna boom back because it's saying it's boom back, or is it just more through experience that you've seen that like this trade does boom back, you know, like.
I mean, if the trade never comes back and it won't hurt you, then it's not a big deal.
Makes sense.
You know what I'm saying? And this could even be like, okay, expected value. It's like, well, if you aren't defining your loss, you could clearly get into some problems.
Yeah.
You know, and that's probably a better assumption to make than saying, well, eventually you're going to lose your full buying power.
Makes
or
sense.
at least it's going to pay off earlier. But I mean, at the end of the day, I'm just a little more committed to what I'm doing.
Yeah.
And I'm sized in a way to where like I don't need it to win to do fine and do whatever. So like there's a lot of bodies on the road to where we've gotten today.
Yeah.
And like there's continued to be bodies as this progresses.
Yeah.
And eventually like it runs out and you know there's only a few people left when it bounces back.
Yeah.
I know that sounds kind of cynical.
But I hear what you're saying. The reference is like, who's going to be still standing at that
Yeah. So, you know, I've set myself up that it's like last year, you know, cool, I can sound all smart and I put all this effort to like doing this hedge fund thing, but it's like I didn't like crazily outbeat the market after fees, you know, like 5% or whatever. And I'm using leverage with options. So like it's very reasonable to be like, this guy, it's not worth the risk.
Yeah.
And then now, you know, that's kind of significantly changed with the market going down. Like it's the same, like the market neutral strategy. So I was always waiting for this moment.
Yeah.
And that's what I built my behavioral bias to.
Yep.
And instead of getting FOMO during that market. So this all comes to like your thing with your portfolio is like, yeah, let's rip it, bud.
Yeah.
And it's like, okay, like we're ripping it. You know what I'm saying? But since you like put that flag in there, it's like you're now going to adopt all the problems that come with that.
100%.
And you're going to have to, you know, go to the elephant graveyard and decide, you know, how you make out on that.
Yeah. You're gonna take your bumps, but then you're gonna come back. You know?
Yeah, but the other thing when we go to behavioral bias is the nice thing about 0DT is like we have the data and we get the reps quick.
Yeah.
So you should be able to adapt very quickly. Whereas if you had done real estate since 2010 and interest rates change, everyone's got a fixed rate cheap mortgage and you're still doing real estate now, you could be rowing in the wrong boat.
Yeah.
And the time frame maybe 5 or 6 years because it's not short dated like 0DT because and it's like people are buying real estate with like a 4% return on it. And it's like you're using debt to hold an asset that like can burn down and whatever for a 4% return. So like that's a critical part of what it is, and
you kind of have to like decipher like where you're at. You gotta be real with yourself a little bit sometimes.
And I think the instrument of 0DT just gives like a particularly good opportunity to know if this is for you or not.
Yeah.
Which is honestly how I got into it, where I was like, you know, I'm interested in this. I can't get material at work during 2020 because of COVID supply chain.
Yeah.
So I could study options and I could learn quick. And then eventually I got laid off and I was like, well, I could go all in for 6 months and figure out if this is something.
Yeah.
And be like, if I can do it with 100 grand, I can do it with 10 million, which was a ridiculous thing to say at the time, but like, it's true.
Yeah.
The path to do it was not. And I think that's like the main component that a lot of people miss out on or don't think when you're evaluating it.
That makes perfect sense. And it's like, I mean, just thinking about the real estate side of things, like I definitely have like a lot more of an appetite to learn the 0DT rather than
I don't want to
estate.
fix toilets. I want to sell premium, you know?
Yeah, like just the lifestyle of it as well. Like,
Yeah,
like,
I guess you tell them. So after watching a day in the life of me, what did you think of it, or a
Oh my
normal day?
gosh, it's the best day of work I've ever had in my life. That's for sure. I was like, it's. He talks about being close to the money all the time, and like that's like the first time I've ever felt like close to the money in my life.
Yeah.
Like, and just seeing the day in the life and the time we did a breath work class, like it was just best day of work you could ask for, you know?
Yeah, and like to kind of bring that up, like Connor was like, "How do you get close to money?" And it's like, I mean, if you kind of think about the economy today, we have like very rich people, and then like everyone else, and it's basically like the closer you are to the businesses of the rich,
Yeah.
or that, it's like the more you can kind of get in the club because like assets appreciate faster than labor, and unless you're going from like 0 to 1 on kind of inventing something with labor, and it's like San Francisco and New York are expensive because it's closer to the people with the money.
Yep.
And like there starts to be an economy where there's service workers that just maintain a yacht, and there's like 40 people employed by just one lot. And so like the closer you are to this stuff, the better. And you can also take less risk from a component. So like if you start a company, like you got one shot and it's a big damn payout,
Yeah.
but there's a lot of time to do that and make money. Whereas like if you run a private equity firm, you have like 40 people doing it. You just plug them with the money, and then like you're like looking over if they kind of do the work. So
Yeah.
the risk to reward on that is much different. But going back to the key theme here is when I was in construction, I used to commute, which is obviously just a waste of time.
Yeah.
You can listen to podcasts, you can learn, you can do the best of it.
Yep.
But like now, I have zero friction to doing what I need to just take a step forward and getting the feedback to do that.
Yeah, and to be dead serious, like taking a step back and like looking at how you guys structure your day, I feel like that's when the human is going to perform the best, just because of like, if I sat here and drilled you all the time, you're almost like this fight or flight. There's not a lot of creativity, but like if you just kind of like what you were talking about when we were just sitting earlier, like when I'm feeling motivated and I'm just gonna rip like a 14-hour day because I'm just feeling it.
And
like,
that's when you're best.
That's when you're best because you're like driven in that moment and you just feel called to that moment. And I think that's awesome. Like it definitely makes me rethink of like the W2 life, honestly.
Yeah, or the other thing too that I was thinking of the other day is it's like curiosity is the absence of judgment.
Yeah.
So when you're able to be curious and not have judgment for some number you're supposed to hit, not live on some like weekly time cycle. And if we want to get really hippie, it's like you reap and you sow the seasons. Like humans are made to like sprint fast, do whatever, not just like systematically do whatever, as someone that systematically does the same thing 252 days a year. But like you could see that I needed to sprinkle in something else because I naturally and systematically have to just do the exact same shit 252 days a year.
Yeah.
And everything's the exact same. My schedule's exactly the same, and that never changes. But to get new perspectives, and that's kind of why you're out here of like thinking, because, you know, I guess we're running a media business or whatever, like we're making content. So it's like getting new people in the room and new perspectives can like make me learn something. And like with the flips of that is like, okay, whatever, I know a lot about options and finance or whatever, but having the humility to realize everyone's superior to you and somehow, and it's your job to figure that out, gives you like a new insight on, how do I apply this to my life, or I following a life based on a story I told myself 5 years ago?
Yeah.
And then you could be in it.
I think anytime, I love what you just said, like I think anytime you take that humble and meek like mindset, like you're not trying to like talk down to yourself, but just like be real and like, hey, I don't have this all figured out. Like you're gonna always come back a lot stronger in that.
Yeah. Or it's like even last year I literally traveled the world for like 4 months and I fucking hated it.
Yeah.
Like, you know what I'm saying? And it was like all I wanted to do was trade options.
I remember talking to you.
Yeah.
I was like, he was out in Spain and he's like, brother, I need to get back home.
Yeah.
And he came home early. I remember.
Yeah, I literally like missed a flight in Dubai because I thought the flight was at 2 p.m. instead of 2 a.m.
Yeah.
And then I literally had already paid like a bunch of money to go on like a 9-day retreat at a private resort in Fiji for like Tony Robbins, which is like my spirit animal guy. And I was like, fuck it, I'm going home to work. And that's just kind of what I always want to do, but that's the whole thing. It's like, don't get married to a story or have like any sunk cost of like
100%.
what you're doing. And like now I think, even though Tony Robbins was a big part of my life, like all I'm going to do is like volunteer twice this year with it.
Yeah.
You know?
I don't blame you. And I think it's like I think all humans can relate to that. Like sometimes you kind of like lie to yourself and you like overinflate yourself a little bit and you're missing out on opportunities to learn when you do that.
Yeah.
You know, like I do that all the time and I have to check myself. I'm like, all right, bro, like you're not where you want to be. Like take a step back, figure out how to get there, you know? Like, yeah. And I think it's healthy that you're able to see that, honestly.
Yeah, or I think I saw something on Twitter. One was like, your ego is the most expensive holding in all of finance.
100%.
You know?
Yeah.
So how do you check your ego?
Honestly, I have to take, like, you do your breath work stuff, and mine's like that quiet time because I notice when I'm busting it.
Do you do enough of that though?
I don't.
Yeah. So this is the whole. This is life and trading. Life and trading.
Life and training. Like I'm not going to sit here and say I'm perfect. Like today checked me honestly doing breath work, and I was like,
this is exactly, and this is the whole thing why, you know, I support people trading 30 grand accounts even though it's not statistically like as good.
Yeah.
Where it's like life and trading, new looks, new whatever, knowing where you're weak, being objective and being honest. It's these same patterns that come up in life and can teach you these lessons and iterations. I think for guys particularly, like money's a little easier than emotions because guys like to keep score.
Yeah.
To like feel your emotions through something through that, you know?
Yeah. You would just have that provider mentality and you want to provide
I mean,
for your family.
you're running like 12-fold because you have kids. Like I'm a little worried if I have kids, like, you know, like what I would be going on in my mind. But
I mean, I think it's like you're running a business, so like I mean, I don't ever try to like knock anybody's thing because everybody's struggle is the same. So like you have a lot on your mind too. So like you're probably your thought process might be different than mine, but it's the same thing. Like you're thinking about providing for people too, and I'm thinking about you're probably thinking about providing for your future wife and your future kids or your current employees, and I'm thinking about providing for like my family in that time. So we both have that fight or flight with that providing thing. Sometimes you got to check that and have trust and faith too, but like it's also kind of all right to let that drive you at the same time.
So
too.
Do you think that's gotten significantly better of you being able to check yourself like within the last 1, 2, 3 years, or like?
Yeah, 100%. Like, definitely. I used to think like, I used to have this mindset, and some people might knock me on that. That's all right. But I used to have this mindset like I have to work hard to provide. Like I have to grind to provide, and that's a good mindset to have because I was taught that during wrestling. But sometimes you have to pull back a little bit and have trust at the same time.
It's good from 18 to 25, but it'll get you a heart attack at 50.
100%. Yeah. Like you might have made $1 million, but then you're a crappy husband and a crappy dad. I'm not saying that people that work hard are that. I'm just saying like there's balance. It's learning that balance, and I've definitely learned that balance like these past 3 years.
Yeah, you get to it's elephant graveyard. You get to call to action.
Yeah.
You have to climb. You have the valley of despair.
Yep.
Then you come back, you know?
And I think this is why I'm so drawn to Zero DTE because I'm like, I see what my life could be like coming out here.
It's better than selling PEO.
It's better than selling PEO, payroll. If you guys don't know what that is, look it up.
If anyone out here needs ADP, payroll
I'm your
services,
guy,
small
bro.
business owner, by the way. Connor here. You can use referral link 0 Day Mark for cheaper PEO. Yeah,
I'll get you the best rate out there.
But no, like just seeing your guys' life, like I think you see, like, of course, I know you guys grind and you work your butts off, but you also have flexibility to really pour yourself into what you really believe in that time. And sometimes, like, on that W-2 grind, you're just grinding. You're like, what did I do to really, like,
it feels almost hopeless.
Yeah, like, what
it's
am
like a victim frame.
Exactly, yeah. So it's it can be tough, but it definitely is grown my appetite for this for sure, and I'm excited to see like what the journey is. And I've been so grateful to be a part of this. Like, we just got past my year anniversary, so I'm excited to see what it is.
Yeah, for all of you, I don't think a lot of people know this, but like Connor is me on LinkedIn quite frequently. We used to work with each other as SDRs.
Yeah,
and he was really good at LinkedIn. So after I left, I was like, Connor's good at LinkedIn. I don't want to do this. Let me hire Connor. So that's why I'm teaching Connor trade options. So,
Hopefully you can
full,
get better at some
full,
LinkedIn messages
yeah,
and
full,
stuff like that.
full backstory there. So if you message me on LinkedIn, Connor may respond to you.
But pass it over to you, man. Like, just thinking about your 5 year. I mean, we've talked about it, and I get really excited hearing you speak about it. But what is your like outlook in like 5 years? It could be personal. It could be with MBH. Like, what are you looking at?
Dude, I'm just big on doing the day-to-day thing.
Yeah,
Like,
I love
building the
that.
life that it's good. Like, you need to get to, like, leave scarcity of kind of like money
Yeah,
and more than just like building this immense amount of wealth, which I think will come eventually. Like, we've talked about tithing, and that's kind of like a cornerstone of it.
Yeah.
But like, if you're in a sprint to try to up economically where you're at to like afford a house, like
Yep.
up your lifestyle for expensive things, it's like, sure, do that. But then you need like a recalibration period to bring back in your health, because that's always going to be like
100%.
the ultimate thing. And I went like kind of way too far over just like working too much and stress and doing stuff.
Was that like last year for you?
Yeah.
Think?
And it's like now, like, we're one day away from the quarter ending, and it's like, oh, this is like, I've been able to get like 6 more months of runway
Yeah.
of not just having like a fictitious business value. So I did that before and have kind of like recalibrated that. And then like you also need to do that with your relationships and evaluate.
Yeah.
But I also think a huge part of that is like you're always growing, and then you're getting new outlooks of even the house you're living in, what you do on a day-to-day basis to
100%.
kind of determine that is. But yeah, just learn and grow. Zero DT is calling to me now. I think dual momentum and that type of investment approach is going to be something in my near future that I do.
Yeah.
But yeah, I mean, I'm doing the hedge fund thing, and I'm very interested in the business aspect of that, even though I'm doing the hedge fund thing, and then just kind of making more of like, I think recalibrating friends, community, and stuff,
Yeah.
where time wise, and I'm going all over the place. It's like it's not the same community or niche that I was in growing up with college or knowing everyone from your hometown when I lived in San Francisco, and everyone lived there, but there's still a lot to gain from that. It just looks a little different now with what that is, and then that brings new takes and whatever that is.
Yeah.
But yeah, I've been doing the whole yes thing for a while, and it's pretty chill now.
You're like constantly reevaluate how to be a good steward of what you've been gifted with. Right
Yeah,
now.
and you screw up a lot too.
Yeah, you
and
do.
that's kind of
You have to remind yourself that every single day. You screw up a lot, and you're like, all right, I don't need to be looking at the 1,000-foot view. I need to pull back and look at my right now.
yes,
And
it's not a big deal.
yeah,
Yeah, it's something to think about though.
it is. It is.
Yeah.
I love it, man. I love it. So what's next for the 30K account? What are we doing next, man?
We're ripping it to 60, and we're gonna add some more trades, and we'll update it on YouTube.
I love it.
Yeah.
Love it. I'm excited to get more into it. Learn some more about the back end of the trades that we're gonna add. Excited
Yeah.
to see what we got.
So I think with that, we're pretty much ready to go to dinner.
Yep.
We'll probably take a picture and maybe post it on YouTube. But we've invited a random YouTube subscriber that lives local to Austin to join us at dinner. So
We're gonna have a
you
good
know,
time.
there'll be weird people joining the channel as we cross paths.
Yeah.
In the beginning. So, you know, we talk to most people, but always an interesting
He was
journey
at
that is.
Breathwork today with us.
Yeah, he came to Breathwork. I don't know if he wants us to release his name, but he also joined us for Breathwork, so he's been part of the retreat. You know.
I'm glad there is not. It wasn't just me. That's the first time. Well, he wasn't a first timer. He's local.
He's from Austin. He's doing weird stuff. He came for our cacao ceremony though.
Yeah, it was pretty cool. Breathwork is awesome, by the way.
Yeah.
Highly recommend it.
Connor's first time. It was good. So,
Yeah.
You see, you know, Connor, he's making money now, but was really separating him from the next level was
Breathwork
his mental
session.
signs. So, you know, we did some couple hours of deep work. So we've brought up our C game, and now we're bringing up our A game as we continually progress forward.
No, yeah, it's been an amazing experience out here, and I appreciate you bringing me out, brother.
Of course, dude. Well, with that, another great podcast. Also, if anyone else wants to be on the podcast, I think we're going to be doing podcasts more. So feel free to reach out or email me or whatever.
Happy to have you guys.
All right, sweet.